Hi friends, good day. Today, let us try to understand about what is bid, what is ask, what is bid and ask spread, what is supply and demand through this video. According to Dale Carnegie, develop success from failures. Discouragement and failure are two of the surest stepping stones to success. Before we go in,
Please subscribe for more videos. Click the bell icon for updates.
the bid and ask price, also known as bid and the offer price, is referred to as the best price at which a security can be sold and bought at a given point of time. They are the two ways price quotation that refers to the best price at which the sellers and buyers are willing to transact at. And individually, bid price means the maximum price that a buyer is willing to pay for the security or a share of stock at that particular point of time, and the ask refers to the maximum price at which the seller is willing to sell the same security or the share of the stock at. A transaction or a trade happens only when the buyer and the seller agree on a price for the security, but the price which they decide on should not be higher than the bid or lower than the ask. So typically, if a trader wants to buy a security immediately, he buys at the ask price, and if he wants to sell the security, he does it at the bid price. For example, if a current price quotation for the security X is rupees 100.50 divided by 100.55, in this the 100.50 is the bid price and 100.55 is the ask price. So the investor A who wants to buy the security at the current market price would pay 100.55 and buy, and investor B who wants to sell the security X at the current market price will sell and receive at rupees 100.50. Coming to the bid and ask spread, the difference between the bid and ask prices is called the spread. Spread is the key indicator of the liquidity of the asset. As mentioned, the ask price is the lowest price the seller is ready to sell, and the bid price is the highest price the buyer is ready to pay for the security or the share of the stock at the particular given point of time. These prices are determined by the two forces. One is supply and the other is the demand. These two forces defines the spread, which is the gap between ask and bid price. When the market is highly liquid, spread value can be very small. But when the market is illiquid or less liquid, the spread can be very large. Supply and demand. To understand more about the spread, investor must first understand the concept of supply and demand. Supply refers to the volume or the abundance of availability of a particular item in the marketplace, such as supply of stock for sale. Demand refers to an individual's willingness to pay a particular price for an item or stock. A tight bid-ask spread indicates an actively traded security with high liquidity, and the large spread indicates illiquid or less liquid security. If there is a significant imbalance between the supply and demand and lower liquidity, the bid-ask spread will expand substantially. So, popular securities, for example, Apple, Netflix, or Google stock will have a lower spread, while a stock that is not readily traded may have a wider spread. For example, if a security received a bid of rupees 10 and the ask of rupees 11, an investor would expect to lose rupees 1 or 9% of their investment if they bought at the asking price of rupees 11 and then immediately changed their mind and sold at the bid price of rupees 10. The size of the spread and the price of the stock are determined by supply and demand. The more individual investors or companies that want to buy that is the more the demand. The more bids there will be, while more sellers or supplier would result in more offers or asks. Some important points to remember in bid-ask spread. The market for any security should be highly liquid. Otherwise, the investor may find himself at a point where there is no exit to book profit in a separate trade. There should be some imbalance between the demand and supply of that particular security, as that creates chance of wider spreads. A trader should not use market order for spread trade. Otherwise, the spread opportunity can be missed. It is good to use limit order where the trader is able to decide the entry point. Bid-ask trade involves a cost as the investor will be doing two trades simultaneously. Bid-ask trades can be done in almost all kinds of securities, but they are quite popular in forex, interest rate yield, commodities. The bid-ask spread can say a lot about the security, so the investor need to know all the reasons that are contributing to the bid-ask spread of that particular security. The investor's investment strategy and the amount of risk he or she are willing to take may affect what bid-ask spread one finds acceptable. Thank you so much for watching. Please like this video and do share.